Attorney Laura Anthony, founding partner of Anthony PLLC, a full-service corporate securities and business transactions law firm. Today is the continuation in a LawCast series talking about the OTC market's regulatory recommendations to improve disclosure and combat microcap fraud. On March 8, 2018, Cromwell Coulson, the CEO of OTC Markets Group, made a presentation to the SEC's Investment Advisory Committee, or IAC, as part of a panel on a discussion of regulatory approaches to combat retail investor fraud. During the meeting, Mr. Coulson discussed the most serious market risks and presented a list of 14 OTC markets regulatory recommendations to improve disclosure and combat these market risks. Today I'm going to go through those 14 recommendations. The first is to increase paid promoter disclosure. OTC Markets recommends amending the Securities Act Section 17B to require additional disclosures related to paid stock promotion and the people involved in such promotions. The second recommendation is to provide more disclosures from affiliates, insiders, and institutions. OTC Markets suggests limiting anonymous objecting beneficial owner accounts for affiliates. Moreover, insider and affiliate trading should be reported by all publicly traded companies and not just those subject to the Exchange Act reporting requirements. The reporting requirements should be similar to those under Section 16 for reporting companies. OTC Markets also suggests expanding Exchange Act Section 13F to OTC traded securities, requiring institutional investment managers to disclose their holdings in all publicly traded securities, including short positions. The third recommendation is to improve share issuance compliance. OTC Markets suggests that transfer agent regulations be modernized to provide broker-dealers with reliable information on the issuance, ownership, and transfer history of shares. Fourth, enable more real-time SEC enforcement. Interdealer quotation systems, like OTC Markets, should monitor ongoing disclosure by companies and have the ability to monitor and label late or deficient disclosures, such as OTC Markets does now voluntarily on its own site. Furthermore, the SEC should work with these market operators to take quick action where there are indications of fraud, including with trading halts and suspensions. Fifth, short sale reform. Require the timely disclosure of short sale positions and of aggregate industry activity. Also allow more market maker short selling activity by amending Regulation Show to extend the closeout time for short positions in OTC equity securities to 6 days, as is currently allowed for exchange traded securities. The sixth recommendation is to allow SEC reporting companies to use Regulation A, which just happened, as a matter of fact. On May 24th, 2018, the President signed the Economic Growth, Regulatory Relief, and Consumer Protection Act into law, requiring the SEC to amend Regulation A to allow companies subject to the reporting requirements to utilize the offering. The SEC finally did so just before Christmas. The seventh recommendation is to allow companies to sell shares directly into the market. By allowing companies that trade on an exchange or an established public market to sell shares directly, they will more easily be able to raise capital and access capital markets. Eighth, facilitate competition in venture exchange legislation. A monopoly venture exchange should be avoided. Any venture legislation should follow the European SME growth market model, be disclosure driven, and include exchanges and ATSs that already serve smaller companies, such as OTC Markets. Ninth, adopt investor suitability standards based on experience and risk tolerance. Broker-dealers should be allowed to establish risk profiles based on trading experience and overall risk tolerance. Similar to this suggestion, I would suggest a modification to the accredited investor definition in line with the SEC Advisory Committee on Small and Emerging Companies' prior recommendations, including expanding the definition to take into account trading experience. 10th, allow payments for market making. FINRA's Rule 5210 should be amended to allow broker-dealers to be compensated for out-of-pocket expenses associated with preparing and submitting a Form 211 application to FINRA. 11th, bring back the Federal Reserve OTC margin list. Non-penny stock OTC securities should be marginable. OTC markets suggest two possible solutions. One, give the SEC, rather than the Federal Reserve Board, oversight of margin eligibility. Or two, like the margin list that was historically published by the Federal Reserve under Regulation T, that margin list should be reinstated to make margin eligible all non-penny stocks that are actively traded on established public markets. 12th, allow small companies to effectively provide employee stock ownership plans, or ESOPs. IRS regulations limit the ability for non-exchange traded companies to effectively offer ESOPs to employees. The definition of an established securities market contained in the IRS regulations should be updated to include securities quoted on OTC Markets Group's OTCQX and OTCQB tiers. 13th, allow trading venues to review and/or submit FINRA Form 211 filings. Currently, only market makers may submit a Form 211 to FINRA. Trading venues registered with the SEC and FINRA should also be allowed to do so. And finally, the 14th recommendation is to update the SEC definition of a penny stock, which is an Exchange Act Rule 3A51-1. Currently, biotech and other research-heavy companies may not meet the net tangible assets exemption from the definition of a penny stock. The review standard for net tangible assets should be updated to take into account interim capital raises for these types of companies. I'm securities attorney Laura Anthony, founding partner of Anthony PLLC and producer of Lawcast. Should you have any questions about today's topic, please visit securitieslawblog.com and lawcast.com or contact me directly. Inquiries of a technical nature are always encouraged.